Welcome to this walkthrough of Colat Company. Colat Company comes from the past SBR exam from March-June 2021. It's a Section B question, and as a typical Section B question, it covers lots of different IASs and reporting principles. Although I will be debriefing on the practice platform, I'm only going to be looking at those requirements which relate to non-current assets and provisioning. Let's get started.
So here we are on the practice platform. As you can see, this question, Colat Company, has a narrative at the beginning. It has two exhibits labelled non-current assets and other natural disaster consequences. It then has a requirement for 25 marks and a word processor response area. Let's read it through. Colat Company manufactures aluminium products and operates in a region that has suffered a natural disaster in November 2067. There has been an increase in operating costs, and the company had to replace a regional supplier with a more costly international supplier. The year end we're talking about is the 31st of December, 2 months later, 2067. Now they've listed off following exhibits. The non-current assets one is talking about information about the non-current assets destroyed by the natural disaster and the effect of a decommissioning of a power plant. The other natural disaster consequences describes potential costs of repairing environmental damage, associated government compensation, and the nature of a hedge against the commodity price and potential insurance policy proceeds. Now, when we look at the requirements, remember I am amending this 25-mark question to be a 15-mark question. Let's have a look at what I've done. You can pick up my Q&A in the folder below this video. So here are the requirements. I am taking out requirement A, which is for 6 marks. We'll do that at a later point in revision. I'm also taking out requirement B3, the hedge on the commodity price risk in aluminium. Again, we will cover that at a later point in revision. So overall, I'm making this question 15 marks. So these are the requirements for my question, even though I'm going to be doing it on the practice platform. Number 1, it says discuss any events affecting Colat Company which might indicate that an impairment test ought to be conducted in accordance with IS 36. 3 marks. We will be using Exhibit 1 and the top narrative for that. Number 2, discuss how the following should be accounted for in the financial statements for the year ended 31st of December. Part 1, the destruction of the non-current assets and decommissioning of the power plant. We will be using Exhibit 1. Part 2, the cost of repairing the environmental damage and the potential receipt of the government compensation. And Part 3, the potential insurance policy proceeds. Those will both be using Exhibit 2. Let's get started. So as is good practice, I would call up my word processor answer document and I would be thinking about copying and pasting the requirements into here so I stay on track. So I'm going to be starting with requirement B. Remember, I'm missing out requirement A. So I'm going to highlight that, right click, copy, move over to my Word document and click paste. And therefore the requirement is in there. Remember that is going to be 3 marks. I'm going to leave my requirements and move on to now answering that requirement. Remember, we need to look at the non-current assets exhibit for this. So read the question again so that we're focused on the requirement. It says discuss any events, so we need to pick out events affecting Colat Company which might indicate an impairment test ought to be conducted in accordance with IS 36. So this isn't discussing how to do an impairment test. This is discussing what indicators there are. Now, as a tutorial note, I've put here, To score marks, you must address the factors indicating impairment. You do not need a detailed description of the accounting for potential impairments or an impairment calculation. You must always answer the question set. So here there's going to be 2 marks for discussion of indicators and 1 mark for a conclusion. Are they appropriate for an IAS 36 impairment test? Let's have a look at the scenario. So firstly, remember, reread the top. Are there any indicators up here of impairment? I'm going to be using my highlighter to help me. So Colat manufactures aluminium products. It's suffered a natural disaster. This is the issue. There has been an increase in operating costs, okay, and it's had to replace its regional supplier with a more costly international supplier. That is an indicator of costs going up, and therefore the profitability of its products going down. That would be an indicator that its assets value in use are affected. So there's one event. Let's now have a look at the exhibit. Again, we can use the highlighter. As a result of the natural disaster, the share price of Colat Company has declined, as a significant amount of non-current assets were destroyed. So the share price has declined is an indicator also, and non-current assets were destroyed. Again, meaning they don't have those assets available. The manufacturing facility is gone. In addition, they've suffered reputational damage, another event. And then we're going to have a look at the non-current assets that were destroyed had a carrying value. This is more about part C, where we're going to be looking at the accounting of the assets that were destroyed and the decommissioning provision. So we'll come back and read that a bit later. So we have some events. We have a more costly supplier. We have a share price that's declined. We have some assets that destroyed and some reputational damage. Let's now construct our answer using the information in the scenario. So needing to construct my answer, I'm starting with an intro. Colat Company needs to determine if there are events that are impairment indicators for its assets and its cash generating units. So I'm going to start with cash generating units events. So I need to get 1 mark for this and 1 mark for talking about assets, remember, and then 1 mark for concluding whether that is an indicator for impairment testing. So here, constructing a full explained sentence. Firstly, there's a decline in the customer demand has taken place because of the damage in reputation. And secondly, the share price of Colat has declined, which again may indicate the carrying amount of the entity's net assets is higher than its market cap. If you had just identified the damaged reputation, I'm sure you would have still got a mark, but you do need to explain what the effect is, which is the decline in customer demand, which affects the value in use of those assets, the recoverable amount. Let's now move on to looking at assets in particular. So here you're going to get the obvious mark for saying it's the damage to the facility, which is obviously an indicator for impairment of those assets. But the increase in operating costs resulting from the replacement of supplier is also an indirect indicator. There's more marks going than 2 marks here. I would say there's 4 marks going here. You just need 2 of them. Let's now look at what you would conclude to get your final mark. So as a result of the above impairment indicators, an impairment test must be performed in accordance with IAS 36. So there's more marks going, as I said, than 3 marks. There's probably 4 to 5 marks, and you just need 3 of them. 1 indicator for the CGU events, 1 indicator for the assets, and then concluding. Well done if you were able to do that effectively. Let's call up the second requirement now. We're now going to be looking at part C. And so I'm now going to paste this one into my constructed response area, close down that because there's too much open. And let's now work it through so that we get the right constructed area. So I'm going to need Exhibit 1 for this part of the question, the destruction of the non-current assets and the decommissioning of the power plant. But just before you go and read the exhibit again, reread the requirement. It says discuss how the following should be accounted for in the financial statements for the year ended 31st December. That is to discuss the various ISs and IFRSs that we should be following to come up with the accounting for these issues and transactions. So let's plan the answer, reading through and using my highlighter again. The non-current assets at Colat were destroyed. They had a carrying amount in the accounts of 250 million. The fair value of these assets were 280 million based on an independent appraisal before that date. Okay. In addition, Colat determined that the power plant will have to be closed and decommissioned earlier than previously expected. So we've got a decommissioning provision that needs to be recalculated. The remaining useful life of the power plant has reduced, so we need to comment on that. What do we do about that? And the non-current assets are valued at using the cost model. Okay, well that's important because we need to now ignore that 280 million because that is not relevant because we use the cost model. It's the 250 million that we're talking about because that's what they carry them at. Let's have a look at how these 4 marks can be achieved. So there is 1 mark going for accounting for the destruction of the non-current assets, and then 3 marks for discussing the decommissioning provision. The accounting for the assets is actually quite straightforward. You are now being led down the path, I know, by saying it's an impairment. But those assets have been destroyed. So therefore the accounting is quite simple. We need to write them off. Now, if you talked about impairment, that's absolutely fine, but you'd obviously say they had nil value, and therefore you would have written them off too. So here I've written the destruction of the non-current assets results in the derecognition of the asset as opposed to an impairment. There's no future economic benefits expected from either its use or disposal. Therefore, the non-current asset of 250 million would be derecognised. You don't need to go on about the fact it's not the 280, you just need to state what they're using. You know it's the 250 because of the cost model. And in fact, you don't even need to say there's no future economic benefits. You just know that there's no value left, they're no longer in use, and therefore you dispose of them out of the accounts. Next, we need to get 3 marks for decommissioning. And the 3 marks will come from saying why we would need a decommissioning provision, what IS that relates to, how we would then account for it, and then looking at, as the useful life of the power plant has changed, what would be happening to that decommissioning liability, and then also what would be happening to the asset in terms of depreciation. So here is how you would structure the answer. For 1 mark, you talk about the decommissioning of the power plant creates a provision and it's recognised as the obligation arises, which is normally the commencement of operations. This is added to the initial cost of the power plant under non-current assets as its IAS 16 PPE. This would get another mark. Then as regards to the change in useful life of the power plant because of the disaster, the present value of the decommissioning liability will increase because of the shorter period over which the cash flows are discounted. And then finally, the remaining carrying amount is depreciated prospectively over the following 8 years. Now, I would actually allocate 4 marks to that answer on the decommissioning element, but you'd be maxed out at 3. Hopefully that's clear. We now come to the remaining parts of Part C. We're going to be looking at Part 2 and Part 4, remember, missing out Part 3. So this is now looking at Exhibit 2, Other Natural Disaster Consequences. So this has been clearly labelled Environmental Damage and Government Compensation, referencing Part 2, and then the Potential Insurance Policy Proceeds for Part 4. So again, before you read it through, refer back to the requirement, it says discuss how the following should be accounted for in the financial statements: the cost of repairing the environmental damage and the potential receipt of government compensation. You can pretty much look at that 4 marks and split it 2 and 2. So reading through, Colat has in the past repaired minor environmental damage that is caused, but it's never suffered a natural disaster on this scale. There is no legal obligation for Colat to repair and restore damage. It's actually the responsibility of government. The IS that we're looking at, again, obviously, is IS 37, provisioning. So we need to question whether they have a legal or constructive obligation to repair the damage and therefore make a provision. So that's where the 2 marks are going. And then when we come for government assistance, you should be thinking government, which IS is that? Let's read it through. The government announced on the 1st of December there would be compensation of 50 million available to repair the environmental damage only, and that companies should apply for the compensation by the 31st of December. By March 1st, 2068, when the financial statements were approved, Colat had only received an acknowledgement for their application but no approval. So government grants is the IS 20. And also there's IS 10 in there, events after the reporting period. So we need to discuss whether that grant is receivable in this year, or whether it's contingent and we should only be disclosing it. So, splitting my page between environmental damage and government grants, I'm going to aim to get 2 points from each of these using the scenario. So, IS 37 states that a provision should be recognised only when there is a present obligation resulting from past events. This could be legal or constructive, which is an established pattern, past practice, or published policies. So, applying to the scenario, Colat has no legal obligation to put right the damage, as this is the responsibility of the government, and the past practice was to repair minor damage it has caused. They have not caused that damage, so this has not created a valid expectation, a constructive obligation. Just to be clear, the future expected costs would not meet the definition of a provision. So actually, I think there's probably 3 marks going there, but max that out as 2. Always try to write a little bit more to make sure you get those maximum marks. Don't leave it hanging for the examining team. Now looking at the government grant, IS 20 is actually accounting for government grants and disclosure of government assistance, which is why it applies. That a government grant is only recognised when there's reasonable assurance that the entity will comply with the conditions attached to the grant and the grant will be received. You could have put in, it is an event after the reporting period, so should be assessed as either an adjusting or non-adjusting event. But in this case, again, applying to the scenario, Colat has only received acknowledgement of its application, and therefore there's no reasonable assurance that the grant will be received and should not be recognised. Further, if it's not probable that the grant will be received, it should not be disclosed. So again, that will be maxed out at 2 marks. Now let's look at the final part, which I am going to debrief, and this is the potential insurance policy proceeds. Remember, we need to talk about how it should be accounted for in the financial statements for the year ended 31st December XT7. So if we look at the narrative, Colat's insurance policy provides compensation for losses based on their fair value of non-current assets, any temporary relocation costs estimated at 2 million, and any revenue loss during the 2-month period for the 1st of November. As at the 30th of December, it's unclear what costs are covered by insurance policies, and significant uncertainty exists as to whether the compensation will be paid. This is indicating that this is a contingent asset, and so this question will rely heavily on IS 37 again. Now, you did encounter this in FR, remember, so again, pointing out that prior learning is crucial to this exam. And so as there's 4 marks going, we need to discuss 2 marks how to account for a contingent asset, and then 2 marks as to what accounting is going to be applied in this situation. Whether we can accrue this asset into the books, whether we can disclose it, or whether we do nothing. So let's read on. Before the financial statements were approved, it was probable that the insurance claim for the loss and the non-current assets would be paid, but no further information was available about the other insured losses. The insurance policy definitely doesn't cover the environmental damage, as that is the responsibility of the government. So let's get started with the answer. So starting with the accounting, IS 37, if you remember contingent assets, does not permit the recognition of contingent assets, and that's what this insurance claim is. But it does allow the disclosure when it's probable. So only when it's probable can you disclose that you might be getting an insurance claim receipt. The recognition of the insurance recovery will only be appropriate when there is a virtual certainty, and therefore it's no longer a contingent asset. It's an asset. So those are your 2 marks for the accounting law or principles for a contingent asset. Let's have a look at applying this now to the scenario. So there's more than 2 marks going here in my answer, but we need to max out at 2. So you could say, in this case, as it appears probable that the insurance claim for the loss of the non-current assets would be paid, this would therefore be disclosed. That would be 1 mark. There would be no disclosure, however, for the relocation costs or the lost revenue, as it's not probable. And you could also say that the policy does not cover environmental damage. That's the responsibility of the government. Directly related 2 marks would be going for saying there's a disclosure of the non-current assets and no disclosure of the rest. So that is that question completed for 15 marks. Hopefully you can see what I've done is clearly show which part of the question I'm doing, clearly labelled the elements to put my points underneath, relating it to the scenario, using the wording in the scenario, and therefore maximising my marks. I'm sure you can replicate that in your exam. So this past exam question I have shown is based on financial reporting topics. So hopefully you now understand how it is important for you to still understand those brought forward topics from financial reporting in your SBR exam. Practice past questions. This will help.